Let's talk about ETFs a little bit more now. Brought it out to the equity space. Get a look at where to position next year after a banner year for U.S. stocks. Joining us now, Tim Urbanowicz, Innovator ETFs Chief Investment Strategist. Tim, it is good to see you here. So we've had a little bit of a pause in the so-called Trump trade now. But as we look ahead to December, how are you thinking about sort of the puts and takes here for the market?
Yeah, Julie, it's very interesting. I think you covered a lot of important stuff there just a few minutes ago. And I think when we look out next year, I think what gives us a little bit of pause is just the extreme sentiment that we're seeing really post the election. And the biggest risk that we see next year is that a lot of the stuff that investors have priced in, mainly around the policy side of things, do not play out. And specifically, when we look at things like tax cuts, there's a lot of enthusiasm that the 2017 tax cuts are going to be extended, that you're going to see a cut to the corporate tax rate. I'm not so sure that's going to happen. I think you have a lot of Republicans in Congress that aren't necessarily going to go for that unless they see it offset somewhere else, either cutting spending or increases in revenue somewhere else. So things like that, or even that if the Fed doesn't cut at the pace that is expected right now, those are all risks just for the main fact that we see markets as really priced to perfection. And that doesn't mean that you can't see the equities continue to tick higher. We actually think that they will because sentiment will continue to improve and go higher, but we need to be wary and conscious of those risks, that there's a lot of good news priced in right now, and any disappointment, whether it be policy, economic, inflation, Fed, really has the potential to put some downside risks ahead in 2025.
Tim, I appreciate you showing up here on Black Friday with a couple contrarian thoughts, because as we all know in investing, nothing goes up in a straight line. But make it simple for folks out there. If they're inclined to think the market is priced for perfection, and we may not get that perfect scenario, like what are the plays from an ETF land? How do you hedge your bets?
Yeah, well, we've seen a lot of interest across the options-based landscape over the last year. Within our lineup, we have particularly seen a lot of interest in our managed floor ETFs like SFLR and QFLR. And really, I think why these have become so popular is they really give investors the way to cover a wide range of outcomes. So SFLR on U.S. large cap equities seeks to provide a 10% floor against losses, while on the upside, you have exposure to U.S. equities, participating about 75% of that upside. That's really important. And when we take a step back, Brian, and we look at just coming into this year, what analysts were projecting, I mean, the range of outcomes was crazy. The closest strategist that we track from major Wall Street firms was about 15% off where the S&P 500 is right now. The worst was about 43% off from where the S&P 500 is right now. So it just highlights, yes, it's good to forecast, good to try to figure out what risks and opportunities might be out there. But at the end of the day, covering a wide range of outcomes is really important. And that's where I really think strategies like SFLR, QFLR with the downside protection and upside participation really hold a lot of value for investors right now.
Well, Tim, let's stay on that, because over the past 2 weeks, we've seen the likes of a Goldman Sachs, JP Morgan come out with a very aggressive S&P 500 targets for next year. I mean, do you think they're just being too crazy with these estimates? What do they need to pull back on?
Well, I don't necessarily think they need to pull back, Brian, but I think what makes 2025 tricky is the starting point for valuations, right? I think we're pretty confident that earnings are going to continue to grow and be a tailwind for equities, just given the backdrop. But what makes 2025 tricky is you don't really know what sentiment's going to look like. You don't really know what's going to push valuations higher or lower. We're of the mindset that the backdrop can be sustained. The economic backdrop is strong enough to sustain multiples where they're at. But can they be pushed higher? Can sentiment improve from here? Or like we talked about earlier, you see any of these items start to disappoint, you don't start to see those tax cuts extended, tariffs start to play an impact, that has the potential to drop sentiment and really drop multiples. So investors start to get disappointed. That's really the biggest risk that we see here.
Tim, what's your single best idea going into next year that might be able to do well no matter what happens with all those elements you were talking about?
Well, I think the two we talked about earlier, SFLR and QFLR, really more so on the equity side of the portfolio. But also our suite of 100% downside protection ETFs have also been very popular. We see those as very prudent in this type of market for investors who may be more cautious. So one coming out in December, DEK, the 100% 1-year buffer ETF. You're looking around an upside cap of right in the 7 to 8% range on that strategy over the year. So still gives you some upside participation, but really takes any of those risks off the table altogether. So that one is very important, we think, for next year, especially for those investors that might be sitting in cash. It's a way to get that money into the equity market. And then another one, for investors that are more bullish and continue to think we're going to go higher from here, we've also been seeing a lot more interest in XUSP. This is a strategy that gives investors multiples on the upside. They give up right around the first 5% in gains, but then expedite those returns thereafter, and only 1-to-1 on the downside. So that's one that we've seen a lot of interest from clients that are very excited about the policy proposals that are going into effect, to be able to use that strategy, not take on more downside, but if we do see another 15, 20, 30% year, it's really a way to really expedite those returns thereafter.
Julie, I'm just filling in today. I mean, can we have this guy back? He's showing up with tickers. I mean, this is just, you're speaking my language here, Tim. Appreciate you showing up prepared on Black Friday. I know it's the day after Thanksgiving. Tim Urbanowicz, Innovator ETFs Chief Investment Strategist. Good to see you.
Good to see you, Brian.